For news to have impact on stock prices, the margin of safety has to be strong and relative valuations have to be attractive. So if the news changes and if the headwinds they become tailwinds, do you think markets are now factoring, markets are now attractively positioned in terms of the valuation setup?
So two things have happened, Nikunj. One is obviously the markets have corrected. So I think over the last 15 months, markets have in fact been down on a headline basis by almost 8-9%. Broader markets are down, as I said, 20-30%. And we have added to the earnings. So the huge overvaluation which India had vis-a-vis the world is narrowed to some extent. The second thing, I mentioned, September and December quarters were not great for quite a bit, for quite a lot of sectors. Though on an overall basis, Indian corporates did pretty well in earnings, led by the financials in particular. But I think as we move forward, I think March earnings will normalize and June can be a better quarter. And I think to that extent, if we just start to discount FY25, which would become the 1 year forward, suddenly Nifty would look like around 16.5 times earnings, which is what the 10-year long-term average is. So I think from like 21, 22 times which we are looking at in the next 3-4 months, we should be start looking at Nifty earnings trading at Nifty markets trading at around 16.5 times earnings, which is in line with the long-term trajectory. So I think that should be good. And on top of it, my view is that the world also should stabilize. The headwinds which the world faced in terms of high energy cost, particularly in Europe, which led to lowering of demand and a lot of again companies going out of production, is slowly coming back to semblance. There was this initial fear that the world might go into a recession. Now the IMF forecast itself clearly point out that there are hardly any countries which would have a recession. Most of the countries will grow, albeit a little slowly. And then you also have the Chinese economy opening up post the new year. After 3 years, you will have a normal Chinese economy, and that should pull the global growth back to a little bit of an upward trajectory. On an India perspective, I think obviously the foreign investors have been selling in India for the last 18 months again. They turned buyers towards the end of 22. However, some events have led them to be again small sellers. But as we move ahead and the indications which we get when we speak to our friends overseas and when we interact with prospective global investors, our view is that second half should see a good amount of inflow, which should more than offset the outflows which you have seen in the first 2 months. So I think overall a mix of global markets and economy stabilizing. I think Indian earnings coming back to normalcy for the broader sectors, and also flows turning positive. They all should basically aid, and the fact that valuations are now not as expensive should also lead to stability and an up move returning back to the Indian markets.
If I look at your last declared portfolio, the January portfolio, which is there in the public domain, there are 2 banks right up there, ICICI Bank and State Bank of India. Now, banks have done well, numbers from banks have been strong, NIMs have been decent. But is this the best what we will get from banks from a long, long time? Because deposits are low, credit offtake is strong, which means either margins will get compromised or growth has to be compromised.
So Nikunj, that is the beauty of the markets. I think January saw the best results from banks, but even then, year to date, banks have been one of the worst sectors in terms of movement. And largely a function of what you mentioned, people are expecting that this is the peak as far as earnings is concerned. And also, obviously there was some collateral damage expectation from what was happening in terms of one large group. However, having said that, if you see, what we are heading into, so the retail side of the credit demand is strong. And for a change, you also have now the capex cycle picking up, and you have corporate demand for credit also moving up. Yes, there will be some impact of the liability cost moving up because FD rates have moved up. But, I think in India, on a percentage basis, the increase in interest rates has been much more narrower. So in US, from 1% to 4% is like 300% increase. In India, from 6.5% to 7.5% is like 15% increase. And I think to that extent, 50, 75 basis point passing on is not an issue. Credit costs have never been so good. And I think a function of all these make us believe that at least for the next 2-3 years, banks and financial services are poised for a good show as far as earnings is concerned. And stocks are not exorbitantly cheap. Obviously they are trading at higher multiple than what they were maybe a year or two back, but they're still trading at around book for a few banks and just around 1.5-2 times for quite a good number of good quality private banks. So we continue to be quite optimistic on this segment.
So what do you think should be the projected return from banks from here, next 2 or 3 years? If one assumes that credit growth of 12 to 15% is here to stay, do you think banks will compound in that same with that same rate?
$1 million question, Nikunj, but just a disclaimer which I always give. I've always been an optimist on Indian markets, and I continue to remain so. And I think banks and financial services are an integral part of any growing economy. So, if our view of banks, the balance sheet growing at 12-13% would mean that profits can grow a higher 17-18%. And because they are I would not say they are, they are at a decent valuation, like they're not overvalued. I would say that returns should mimic at least the profit growth.
What is your projection for profit growth for next 2 to 3 years? Because for last 2 quarters, what we've seen is earnings downgrade, not an upgrade.
No, for banks, earnings have been upgraded. Yes, generally for the corporate India, as I mentioned earlier, there were headwinds for quite a few sectors in the September and December quarters, and we have seen some downgrades. But I think overall for corporate India, we still continue to be quite optimistic of a 15-16% earnings growth for the next 2 years. Obviously, 24 would be led by financial services, where the earning trajectory would be higher, but other sectors would catch up, over the next couple of quarters. And Nikunj, we also have to keep in mind that 24 is an election year, and historically we have seen that both consumption as well as capex on the government side picks up in the run-up to the election. So I think that should also be a tailwind as far as the growth in the economy and corporate profit is concerned. The other thing is, some sectors, some companies which had an exposure, particularly to Europe in terms of exports, have suffered last 6 months, and now Europe is slowly starting to get its feet back, and that also should start to become less of a headwind in the next couple of quarters.